Gamma exposure is almost like a throttle for volatility. High positive gamma from dealers means they trade against the market direction, suppressing volatility, while volatility itself then acts as a trigger for equity exposure, meaning lower volatility, all else equal, is going to lead people to ramp up their exposure to equities. They're perceived as less risky. Now, that all feels very crazy until you start thinking about things like mechanical flows that are tied to things like insurance company operations, et cetera, and are forced to ultimately manage their risk in this sort of rear view mirror fashion, right? So we're absolutely looking at this dynamic. And the chart that I wanted you guys to focus on here on the right-hand side, this is looking at the dealer exposure by gamma regime. Now, some of this is purely mechanical, right? Because when people hedge, they buy downside volatility. That means the dealers are often going to be pressured into a negative gamma position because you're net buying the options rather than selling the options. Whereas during bull market environments, things just naturally result in lower volatility. Volatility lowering itself means there's a smaller range of possible outcomes, which reduces hedge ratios, et cetera. And so we tend to get this. Now, I just want to emphasize that you can have some of the most violent gains, and David was just alluding to this, during periods of negative dealer gamma, right? All it's telling you is there's going to be a higher probability of volatility related events. If we keep going through and then talk about the dynamics of volatility as a trigger, now let's talk in some detail about these volatility controlled funds. Craig, can you talk through slide 11?
Yeah, absolutely. So we spoke about vol control funds a little bit earlier in this video, but and just to kind of recap, a really important point to make is when dealers are in either negative or positive gamma, that doesn't necessarily add some sort of directional component to the market. All it means is volatility is going to be increasing, and it doesn't even have to increase. It just increases the probability that we're going to see higher volatility. But again, it doesn't add a directional component. It doesn't create a trend. So when we look at gamma exposure as a throttle for volatility, we look at volatility as the toggle for equity exposure, and that's really what we're trying to capture within our vol control model here. So again, vol control funds or risk targeting funds are generally in the insurance space. They're a very popular strategy in the insurance space, and it's to mitigate some of these risks from a major drawdown. So vol control funds typically follow either like a vol target, which means how much volatility they want their strategy or their portfolio to have. And they usually set it at between 5% for a very low volatility portfolio, 10% or 15% if they're willing to take on a little bit more risk. And what's really important about these strategies is they use something called volatility scaling, which uses realized volatility as a toggle for equity exposure. So as realized volatility rises, these quant funds, these vol control funds, are going to sell their equity exposure. And when realized volatility decreases, they're going to be buying back equities. They're going to be adding risk to their portfolios. And again, within a framework of an inelastic market where there's these constrained supply and demand dynamics, these flows really have a large impact, typically with some sort of multiplier effect versus whatever notional amount that we're going to be able to track.
So I would just emphasize that when we start thinking about this type of dynamic, these types of exposures, this seems a little crazy until you recognize that it's basically the same thing as like targeting a moving average crossover, right? So on a price-based dynamic, we're all familiar with the language. If stocks are above a 50-day moving average or a 200-day moving average, that's bullish. If stocks are below a 50-day moving average or a 200-day moving average, that's bearish. Or if the 50 crosses over the 200, et cetera, right? We're all familiar with those types of dynamics. This is doing the exact same thing within the volatility space, and it actually is an outgrowth of one of the biggest risks that you have when you're doing a trend following strategy, is that the market actually becomes highly low, or becomes very low volatility, And as a result, you're constantly being whipped around by 50 and 200-day crosses, right? So a very low volatility market will almost by definition be crossing over and under its 50-day moving average or its 200-day moving average repeatedly over the course of that time period. It's just not moving all that much. As a result, it can shake you out of positioning. Volatility control strategies were designed to help deal with that same dynamic, lowering the overall transaction frequency. And then, as Craig was pointing out, part of the reason why we pay attention to these is it's not as simple as saying, well, what is the crossover? Where did it hit this level? It becomes a continuous increase in exposure or decrease in exposure. And so one of the things that we focus on is this idea of what is the overall positioning in the market. If I go back to September 22, for example, 2022, and I look at the positioning of vol control funds, how did that stack up, Craig?
Well, exposure was a lot lower because we were seeing more volatility. And as I mentioned, as realized volatility climbs, vol control funds end up selling off their risk. So since then, since about, October of 2022, volatility has started to come back lower. And we're seeing that now with realized vol, both a 1 month look back and a 3 month look back, and even the VIX sitting at these 52-week lows. So as volatility has decayed over that time period, it's caused these funds to build up exposure over time. And in fact, I think now it's just year to date, we've seen vol control funds add about $120 billion of equity exposure, which means all of that cash, all of those flows have gone into the market and helped support this year-to-date rally that we've had.
So that's a really important point, though, and it's why I wanted to hit on it. When we think about the impact of these types of mechanical flows, one of the great things is when exposure, in other words, positioning, gets really low, as it did in September, October of last year, well, how much selling can they actually do? They can't really sell anymore. Likewise, if we go back and we look at early 2020 or even late 2021, there were elements of exposure that were dramatically higher. 2021 is not a great example because volatility itself remained relatively elevated, but certainly going into spring 2018, certainly going into January, February 2020, we were experiencing high levels of exposure for these types of strategies, suggesting that unless they attracted new capital, unless new money flowed into these types of strategies, they were largely tapped out as a buyer. That neutralizes them in their positioning. And as Craig was pointing out, right now, we would guess that we're probably about 75% to full allocation across things like volatility targeting strategies.